Hey guys, this Max Convexity here. Hope everyone's having a great day. I wanted to do episode 3 of my basic option trading course. I guess I should have got the spreadsheet up first, but call option basics. Okay, I made a spreadsheet, which which after I get the bugs worked out of it, I'll upload it in case anyone wants it. But we've had episode 1 and episode 2. Just to review real quick, episode 1 was on buying call options. Buying a call option gives you the right to buy the stock at the strike price of the call option on or before the expiration date of the call option. Basically, it's like renting a stock until the expiration date. And it's not even like renting the whole stock. It's just like you're renting the upside on the stock above 100. A put option is the opposite. You're renting the downside on a stock below the strike price between now and whatever time the expiration date is. The main thing to know about buying calls and buying puts or buying any option is options have something called extrinsic premium, which is time value. And the time value always goes to zero by the end of an option trade. So you're fighting time value when you're buying an option. That's why the professionals like to sell options, because they're earning the extrinsic. That's what Jay does at Yield Max and Defiance. That's the whole business plan of all these covered call funds and these short put funds. What they're doing is they're earning extrinsic income the way professionals do it by selling options. Now, selling options also has some drawbacks, and it's more advanced, and we aren't going to talk about selling options probably for a couple more days. Today, I just wanted to talk about buying calls and buying puts again. And I want to work through a real-world example. It looks like my sheet is already loaded up with the big trade from the other day. This was an option trade that Defiance made. Now, Defiance actually sold this option, but we can look at it as buying an option too, because if Defiance sold it, somebody else bought it, and they bought 162 of these options. This was on the NDX, and these options were super expensive. It cost $116 to buy this option. The strike price was $17.40. All right, so the break even is $17.40 less $116, which is $16,923. The difference is because of that extrinsic premium, or that's why this option's so expensive, because there's a ton of extrinsic premium in it. Anyway, so it's a great deal to sell these, but not a great deal to buy these. This trade ended up being a huge winner for Defiance. The person that sold these came out like a winner, because the break even was $16,923 for the buyer. The minimum profit was $17,040 for the buyer, and the stock NDX ran to like $17,300 that day. So whoever bought these contracts, they lost $1.8 million. Doesn't mean that people that buy options lose every time, but this is just a good example of a very expensive option that did not work out well for the buyers. Like I say, Defiance was a seller, so Defiance made $1.8 million. If you're the seller of an option, you generally win about 2 times out of 3, depending on which option you sell. And that's why the professionals do it. And that's why strategies that require income, these ETFs are trying to pay an income to you. These Defiance and Yield Max, they aren't trying to pick which way the market goes. No, they don't care about that at all. All they do is they're trying to generate an income by capturing this extrinsic premium or the time value. So I know this is a little in the weeds. Let's talk about a real life example. And since we're talking about the Defiance funds, let's talk about TSLY. Well, this is actually Yield Max, but let's talk about TSLY. TSLY is a Yield Max property, and it is based on the underlying Tesla, as I'm sure we all know. Well, the underlying Tesla has earnings, I believe, after the bell today. So wonder if Tesla misses earnings. and the stock drops real big. Well, that will make TSLY drop as well. Okay, so I'm not recommending this trade. I'm just using it for an example of, we're just going to use it for an example, and we'll paper trade it, and then we'll come back on tomorrow and we'll see how it would have worked out. I'm betting it loses money. So don't do this. This is just for educational purpose. This is literally, whenever I talk, I say educational purposes, but I am really trying to, I do really believe what I'm saying, and I think I'm qualified to say it. But on this, this is strictly for education, for real. Do not spend any of your real hard-earned money on this. I just want to show how a put option works. Okay, so we're going to use barchart.com, and we're going to use OptionStrat. If you don't have OptionStrat, you may want to go get it. It's a really good option simulator. And hey, check this out. See all these options? See all these? These are all different kinds of option trades you can do, and we're going to learn every one of them. I'm going to go through each one of these, or most of them. We're mainly going to concentrate on some of the good ones. We'll mainly concentrate on the bull put spread and some other ones, but we're going to at least talk about all of these over the next couple of months or whatever. So options are fun to learn about. A lot of them have cool names like the Jade Lizard. Anyway, this simulator will let you practice trades without and let you paper trade them, and it's just a good way for us we can check back in and see what the simulator says. Like I always say, and I promised, I'll do this for 6 months, and then if we're profitable on paper, we'll start doing it with my real money towards the end of the year. Lots of times October is a great time to trade options anyway, because it's super volatile, and the fall is a good time for options. So, but let's learn for the next couple of months and see what we can figure out. Okay, so today we're going to do this one. It's called a long put, and it just means you buy a put. So, all right, so we're going to do a long put. I loaded up TSLY in there, but we're going to go to the option table. You have to be, when you're an option trader, you want to be real familiar with the option table. I always use side by side. You can either choose stacked or side by side on bar chart. Most things come in side by side. That's the way. I started reading these in the paper a long time ago, and that's the way they publish them in the paper. So side by side means calls are on the left side, puts are on the right side, and then right down the middle, that's the strike price, okay? So what we're going to look at is we're going to pretend like we're bearish for earnings tomorrow, and we want to hedge our position. Like I say, do not do this. But we're just going to pretend like we are, and it looks like other people are trying to do it too. So what I'm looking at is, first thing to know is where is TSLY, the stock that you want to buy options, where's it trading at? Okay, well, it says up there in the corner, $9.83. Okay, so here's what I think we ought to do. Also, maybe as these shows get more advanced, we might start doing a Twitter poll, and I'll come on here with a couple of trades and let you guys pick which one. But for today, for now, I'm just going to pick what we do. I'm in charge of this thing. All right. So but I'm going to look at two different things. So we could buy the $10 put for 75 cents, or we look over here at the bid. Well, the bid or the last, whichever one's higher is probably what we're going to have to pay. So we're just going to say that one's going to cost us 75 cents. We're going to say, I'm sorry, it's the ask or the last. When you're buying something, you buy on the ask. When you're selling something, you sell on the bid, unless you're the market maker, but don't worry about that. All right, so what are we going to look at? So this $10 strike put costs 75 cents, and this $9 strike put costs 25 cents. All right, so I might just put them into the calculator. Let's go back here to the basic option calculator. We're going to change the underline up here to TSLY, and we're going to put $9.83 in, because that's the current price. All right, and then we're going to what we're going to do next is we're going to put the strike price in. I don't even know how many days till expiration it has. Probably about 3 weeks. This doesn't really matter that much for this lesson, but we'll just put 20 days there to hold the place. All right, so we're going to first look at the $10 strike price. Now remember, that was the put that cost 75 cents. So what that's going to do for you, if you buy that put, that's going to give you the right between now and the next 20 days, or whenever this thing expires. It's sometime in the middle of next month. But it's going to give you the right between now and then to sell TSLY at $10. And if you're saying, well, how can you sell something you don't own? You usually can't, but what it's giving us the right to short TSLY, in other words, which is selling something we don't own. But the reason we're interested in this is because if we think Tesla's going to miss earnings and it's going to drop, let's say Tesla drops 20% tomorrow, and so that means TSLY will be down about 19%. That's just the way it works. These high yield funds don't drop quite as far as the underlying, but they drop, pretty far. So anyway, we don't want to see a 19%, ding in our portfolio. So think about that. 19%, we'll just call it 20%. 20% of 10, and we'll call that $10. 20% of $10 is $8. So that means the stock would go to $8. That would be bad. We don't want that to happen. So we're going to look at two alternatives on what we can do about it. All right, so starting with this 10 strike price, what we're going to do is we're going to go down here to, I need to clear all this out. Okay, well that actually is good. That's the strike price. Okay, here's what we're going to do. All right, so, well, here's the first thing we need to do. How many shares of TSLY do we have that we're trying to insure? We're trying to buy insurance on. Let's say we have 500 shares of TSLY, just for fun, okay? Well, how many option contracts would you have to buy to insure 500 shares? Well, each option contract equals 100 shares of stock. So if we wanted to insure our total TSLY portfolio, we would have to do 5 contracts, okay? And the price that those guys were asking for that thing was, what was it, 75 cents? So we need to write 75 cents. Okay. And that's a 10 strike price. Okay, so here we go. We're going to buy, or we're looking at buying 5 contracts, put contracts, at the 10 strike price for 75 cents. All right, that means our total cost is going to be $375. And if you think about that, each option is worth 75 cents, but options are priced in units of 100, so that actually equals $75. So $75 times 5 equals $375. We're going to assume we use Robinhood and we don't have a commission, just to make the math easier. But even if we did have a commission at somewhere like Tasty Trade, it'd be a couple of bucks. It would maybe be $5 or something. So anyway, but we'll just assume no commissions to make the math easier. Okay, so the first thing that you always want to look at, the first thing I do, my brain automatically does this, and yours will too once you learn options. I take the premium, how much they want me to pay for it, and I subtract it from the strike price, and I figure out my break even. I'm having the computer do it for us, but I knew the break even was $9.25 the second I did it. I mean, because that's just what option traders do. And if you're buying a call, it's the opposite. It's the strike price plus the premium equals the break even. But in any event, so what this contract is saying is, it's saying, hey, we aren't even going to start to make money unless this thing gets under $9.25, and it's $9.83 right now. So it's going to have to drop a pretty far way to be profitable. That's fine though. So then the next thing I always want to look at is the intrinsic and the extrinsic. All right. And these things aren't either good or bad, but you just want to know what they are. The intrinsic is the in the money amount. So this option gives us the right to sell TSLY at 10. Well, TSLY's at 983 right now, so that's instantly in the money. And that's what this 17 cents reflects. It's instantly, let's see, it's instantly in the money. So that's awesome. But then what you do is you subtract 17 cents from the premium, which is 75 cents, and everything else is the extrinsic. And extrinsic is bad. You want to generally, if you're buying options, you want to spend as little as possible on extrinsic. But if you're selling options, you want the extrinsic number to be high. In this case, though, we aren't going to worry about it too much because we're afraid of the stock going down. We aren't that worried about getting a good deal on the option price itself. We'll talk more about that in future episodes. We're just trying to protect against a black swan. All right, think about my example. If it goes to 8, if it drops 20%, well, I know instantly we'd make $1.25 because I know in my head the break even's $9.25. The difference between $9.25 and 8 is $1.25. But so my head's going to do that automatically. But you can punch it into an option calculator, and it'll show you. Okay, so if it goes to 8, price on expiration. Let me make sure this calculator's right. Yeah, okay, perfect. So that's the ending price of TSLY right there. I should have put ending stock price, but it needs to. So beginning stock price is 10, ending stock price is 8. Okay, so then this calculator calculates how much profit you would make. And you remember when I said you would make $1.25? Well, because I was figuring net profit. I always think in terms of net. The calculator figures gross first. So that option that you bought for 75 cents will be worth $2 to you if it goes to 8 by expiration date. Okay. Well, of course, your net profit's $1.25. And so that's 166%. And we'll talk about premium per day later. That's more when you're selling options. Don't worry about that. Now down here, just for fun, I compared what it would cost. You always want to compare an option trade to the equivalent stock trade. And so here is a dude that just has 500 shares of TSLY and shorts them, because that's the same thing you're doing when you're buying a put. You're synthetically creating a short. Or it's more accurate to think you're renting the downside in a stock. Your rent payment is this, $75 times how many contracts you have. But that's what and it lasts till the middle of, I think it was February 16th or something. All right. So, but this is just what would happen if a dude, shorted the same amount of stock. Well, one thing, it would cost him more. You're only spending $375. He's spending $49.15. All right. But he made $915 because if it goes to 8, stock's real easy to figure out. It's the difference between 983, which is where it's at right now. If he shorted it right now, he'd get it shorted for 983. It goes to 8. The difference is his profit. Easy peasy on stocks. But I'm going to show you why options are a better alternative lots of times. Well, I'll show you right now. Okay. Wonder if tomorrow the opposite happens, and let's say the price goes to 12. What's going to happen? Well, the guy that bought the option, it's going to be worth, wait a second. Ending price 12. I may have an error in this calculator, and that happens sometimes. Because there shouldn't be a profit. What I was trying to show is if you buy a put contract at a 10 strike price and it goes to 12 on expiration, you don't have a profit. You lose $375. You lose whatever you put in. What I was trying to demonstrate is the guy that shorted the stock actually does lose money, loses a lot of money. He loses $1,000. Because when you short a stock, you just make or lose the difference of what it goes up and what it goes down. The reason people like options is if you pick the wrong direction and your option doesn't go in the money, and that would be in this case, your option it doesn't go under 10 or really under 925, then your option is going to be worth 0 at expiration. And you're going to lose $375, which sucks. But what I was trying to show is it's better than losing $1,000. All right, I'll work on this. I'll figure out this what's going on with the calculator. But you're just going to have to trust me. It'd be worth 0 if it went to 12 on expiration. All right, so like I say, I wouldn't recommend this trade in real life. Let's look at something else. I also wanted to talk about how options were priced. Well, yeah, it is February 16th is the expiration date. So just look how much difference they change by time. So in February, we could buy this 10 strike put for 75 cents. But if we wanted a longer insurance policy, if we wanted to go out another month, let's see how much more it would cost. it costs $1.35. The options price, it has to do with several things, but one of the main ones is how much time's left till expiration. Another thing it has to do with is where is the option compared to where the money is. It in the money or out of the money? When you go down, when you go out of the money, like to 7 or 8, these options get cheaper progressively. Let's look at this. Let's look at this. Let's look at TSLY and the option profit calculator. So there's our 10 put. It's saying 80 cents. We were talking 75, whatever. We'll put in 75 just to remain consistent. Okay. So, all right, and here's the time right here. All right. So, let's do this. All right, so here's what our position's worth right now. I mean, if we put it on right now and try to take it off, it might be worth 72 cents profit or whatever. But anyway, what's going to happen as time goes by, watch our profit line. The profit line is going to go, the dotted line is where the stock is. So if the stock doesn't move and time goes by, we're going to, we're going to be down. We're going to lose money. You can see the time going off the timer. All right, so let's look at this. Well, but first let's look at this. All right, so the problem with the 10 strike call or put is it costs 75 bucks. So if whatever you think is going to happen doesn't work out, you're going to lose 75 bucks. So I wonder if you don't want to lose 75 bucks. I wonder if you don't have $375 to insure it with, or you just don't want to spend that much. Okay, well, let's look at the 9 price, the 9 strike, okay? Well, let's look at this. The 9 strike is costing 60 cents right now. So instantly in my head, I know $8.40 is my break even. 60 cents less 9 bucks. I don't even have to go to the calculator. So I know when I'm looking at this option, I need it, if I want to buy the 9 put, I need it to drop to 8.40 to break even. If I want to get this 10 priced, and the prices have moved, these things are going up. TSLY's probably dropping right now, or the market's probably dropping anyway. But if I want to buy the 10 strike option, put option, then I need to get it under 925. So it all depends on how bearish I am. If I knew it was going to 0, or if I thought it was going to 0, I'd probably just buy the 8 strike, because you'd still be plenty of profit and you wouldn't have to risk that much money up front. This is where the hard part about options comes in, is deciding which strike to buy, deciding which expiration to use. Oh, and also it wasn't going up. I take that back. I was on March, so of course the prices were more expensive. I was like, damn, this thing must be cratering. All right, the 10's still 80 cents. Forget what I said about the 9. The 9 that we're looking at is 25 cents. Okay, so that one might be a better option. Let's put it into the calculator and see if we like the 9 better. All right, at 25 cents, what's the first thing we know? We know 8.75 is our break even. All right, so the strike price, we're going to switch this to 9. We're just going to leave that like that. And we're going to switch the premium to 25 cents a quarter. And we're still going to say we want to insure 500 shares worth of TSLY. Okay, so this one, okay, this is good. Good news, bad news. Just like I always say in investing, the good news is this position cost you less. It's only $125 instead of $375 or $350, whatever that last one was. Okay, great. Bad news is the break even is lower. We need more of a move to be profitable. So, also to demonstrate, this option is out of the money. And out of the money, whenever somebody says in the money or out of the money, they mean from the standpoint of the buyer. So from the guy that's buying the put option, the money means getting in the money means it's less than 983. If this was a call option, getting in the money would mean it's more than 983. All right. So this one you have to get to 875 to break even. There's no intrinsic because it's not in the money at all. It's all extrinsic. Like I say, that's neither good or bad. It just is what it is. All right, so let's look at this. Let's do an ending price of $8, just like we did in the last one. All right, so at $8, this option would be worth the difference between 9 and 8, which is 1. but we paid a quarter for it, so it would be a profit to us of $375. All right. The 300% profit, that's a more percentage profit than last time, and we use less money to start with. This option is offering more leverage because it's cheaper. But when we're trading for that leverage, we need TSLY to go down further before we start to make money. All right, so here's what I'm going to say. Let's just do this for today. For today, I think that we ought to paper trade this option right here. I think the other one was too much money to spend. I don't want to lose $375 if I'm wrong. This one at $125, and let's say a black swan. Let's say something really bad happens and Tesla drops to 7. Or TSLY drops to 7. I don't think that's going to happen, but let's say it did. In that case, the option would be worth 2, because that's the difference between the strike price and the ending price. And it would be worth $1.75 to us because we spend a quarter on it. So, that'd be pretty nice to have an extra $875 if TSLY drops like that. That would offset some of the loss in our stock position. Now, it wouldn't offset all of it because of the difference between the strike price and the break even. So we would still have to take the loss from 983 to 875, but then anything underneath 875, if it went to 7, the rest of the way would be covered. And so, our stock position would drop by $875 between the prices of 875 and 7, but we would get an $875 winner in the option trade to offset some of it. All right, so I'm just going to say for today, let's just go. Let's buy this. I'll put it in the option trade thing. I'll get the spreadsheet working. I'm sorry, I don't know why I need to fix that. I apologize. It'll be fixed by tomorrow. So what we're going to do is we're going to get this 9. And it's showing a bid of 20, which means the price that sellers have to sell it for, or usually have to sell it for, and bid is the price that buyers usually pay. The market maker makes the 5 cents in between these things. That's what he does for making a market. He gets the 5 cents because he can actually buy down here at 20 and then sell it to us at 25, and he can do the opposite. He makes the nickel all day long. That's fine. So we're just going to assume for this one, we're going to pay 25 cents. Now, if this were a real life trade, what we would probably do is put in an order, and we'd probably put in an order for 22 cents. And we leave it in for a little while, and then we might move it to 24 cents and see if we have any takers. And then eventually we'd probably end up having to pay 25. For the sake of this class, we aren't going to try to get a better feel. Let's just assume that we get 5 of these little guys down here. We'll see how it works out. Okay, so like I say, the time-wise, where that comes in handy, let me show you. So I'm thinking of just holding this option for a day. I'm saying if it doesn't work out by tomorrow, I'm probably just going to dump the option. So so we can move the date forward to Wednesday, all right? And this will show you where the stock is at, how much the option will be worth. My calculator showed you that it would be worth $2 on expiration if the price dropped to $7, but that's on expiration. This calculator can figure out between now and expiration, because between now and expiration, the stock will still have some extrinsic, or the option will still have some extrinsic value. Anyway, so let's say even if it doesn't drop, where we need it to, if we can just get it to drop to $9, according to this calculator, we'll have a $129 profit. That wouldn't be bad. Like I say, and I think we probably ought to just do this for a one-day trade in case a black swan hits, and just take whatever we get. If it opens tomorrow at $8, we ought to take the $400. If it opens at $7, we'll take that. Just take whatever we get. But let's say this, just for an example. Let's say it dropped to $9 tomorrow, and we decided not to take that money. Okay, well, tomorrow it would be worth a $130 profit. But let's say we screw around and we wait till Friday. Well, on Friday it'd be worth even less. And then let's say we want to hold it till next week. And I'm just assuming the stock doesn't. Let's say we hold it into February. Well, into February, that it's going to be worth a lot less. Options decay. So especially when you're buying them, I like to do them for quick in and quick out. I think we ought to just try to hit this thing, see what it does, and then we'll get out in the morning regardless of where it's at. Or well, we'll think about it. Maybe I'll do a Twitter poll or something. But this isn't that big of a deal. This is not a very fun trade to do. We'll learn how to do better trades. I'm going to show you guys how to do spreads and how to do trades where the odds are in your favor, like Defiance does. But first, we have to get a good handle on buying calls and buying puts. But just remember, this is not a good idea and probably not what we should be doing. But we're just going to try it okay, so I'm sorry. We're going to save this trade. Okay, and we're gonna trade description. We're gonna put in case TSLY has a black swan because Tesla has a bad earnings report. Okay, yeah, so we'll save that trade, and then the calculator will keep track of how much we made or lost. We'll come back tomorrow and look at it. Like I say, this wasn't the best lesson. I'm sorry the spreadsheet messed up. But if we just take this in small bites, maybe tomorrow we'll look at buying a call. Maybe the rest of the rest of the week we'll buy calls and buy puts. See how we do. Probably lose money. Usually when you buy calls and puts, you lose money. But we'll see what we do. And then we're going to get into spreads, where we buy one call and sell another call, or buy one put and sell another put. That'll be next week. And also we'll also talk about covered calls. And we'll probably talk about covered calls on Friday. And I just thought of something else we can do. But anyway, I'll save that for Friday. On Friday, we're going to put on a hypothetical covered call trade for 1 week. And we'll let that play out for a week. But we're just going to do some daily, like, fun option trades, the next couple of days, and just try to get a handle on this. Anyway, I'm sure there's a lot of stuff I missed, and if I confused anyone, I apologize. I'm in Discord. I'm in lots of Discord servers. You can find me there if you have questions, or leave the question in the comments, and we'll figure it out. All right, guys. Hope you have a good day. And I actually hope, and here's my prediction, just so it's on record. I think that even if Tesla misses earnings, even if the earnings report isn't great, and even if Elon says something bad on the earnings call or something, I think Tesla might be down for a day or something, but then I think it'll go back up. I think my theory is that the bad earnings is already baked into the price of Tesla. Let's look at the chart real quick here. All right. Well, the market turned around a little bit. This is a 3-minute chart of the market, but I was looking at that earlier. But let's see here. We're gonna check out a daily chart on Tesla. 3 minutes is a little too. I want to get some more. I want to step back and get a little better perspective on this thing. All right. Well, if you step back and you look at where it's been, I mean, go watch Mike, the tactical stock scalper. He'll give you all this technical stuff, but I see a pretty obvious downtrending line there. Somebody in one of the Discords today was talking about they sold some at 260 when it hit this downtrending line. Anyway, we aren't worried about that. What I'm saying, though, is I bet you the reason it dropped from 260 to right here is because people were freaking out about earnings. And they probably were selling it in advance of the report. And so I'm hoping, regardless of what happens tomorrow, it may goes down a little bit, but then the general, they'll be able to turn this boat around and get it going the right direction. That's what I'm thinking. Anyway, I've heard Mike, the tactical stock scalper, is going to have some advice, and he had some good advice yesterday, and I don't think his video's made yet, but he's going to have a video sometime this afternoon about Tesla earnings, I believe. Definitely go check him out. I'll put the link to his channel in the description. I'm sure you guys already know who he is. I pump his channel all the time, and he recommends my channel too. So we have probably 90% of the same subscribers. But in case you don't know who he is, he's really good. Has a lot of good advice too about a bunch of stuff. He's been real successful in business. And anyway, all right, guys. So it sounds good, and I hope you guys have a great day. And I will talk to you tomorrow on this option. We'll figure out what's going on probably tomorrow about 9 or 10 in the morning. Thank you very much.